Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
A very good afternoon to all the participants who joined into this week's broadcast or point of view. We're coming to you after a bit of a gap, which was interspersed with corporate earnings for the second quarter. My guest this week is Mr. Trideep Bhattacharya. He's the Senior Portfolio Manager at Alternate Equities, Axis AMC. Trideep's had a career that's spanning over 2 decades in the capital markets. He is a BTech in electrical engineering from IIT Kharagpur. He subsequently pursued his MBA at SP Jain and is also a charter holder for the CFA Society. He's spanned a bunch of organizations in his career, from an intern at Tata Motors to Kotak to a reasonably long stint at UBS, to moving to Ireland and working for State Street. And the last 4 or 5 years he's been with Axis AMC. Trideep, good to have you on the show. Thank you so much for joining in. And at the outside, hope you, your family, your colleagues are safe and wish you and your entire team a very happy Diwali.
A very good evening to yourself and all the people who have tuned in to this call, to all the viewers. Thank you very much for your wishes. We certainly are so far so good, healthy and safe. Thanks for inviting me to your show. I've heard good things about it.
Well, I hope we can do justice to it over the next few minutes. Trideep, let's start from the from your formative years. I think pretty much everyone that I've had the opportunity to speak to on this platform over the last many months has a very similar educational background. It's been IIT followed by IIM, and I've asked so many people whether this was the best matrimonial commercial back in the day for finding the right bride. But talk to me a little bit about your engineering days, because I sense your first job at Tata Motors was an offset of your engineering days.
Yeah, absolutely. I think I grew up thinking. I mean, I grew up in a steel city called Bhilai in the central part of the country, which is now Chhattisgarh. In our time, it used to be Madhya Pradesh. And given that it's a steel city, given that there is a steel plant in there, majority of the people working there were engineers. So, and once you're surrounded, ultimately a man is known by the company he keeps. So, in and around us, I mean us as in our family during our formative years, there were lots of engineers, and that's how the mentality kind of, got in there. And Bhilai still is known for producing good quality IITians, so to speak. And that's how the initial dream got formed of, doing, actually getting into an IIT. And given that IIT is an engineering degree, to kind of, do well there. That's how it all started. And I think it's got not to do with the deep passion for engineering, but it's just, in my opinion, the aura that that institution carries around itself. And that kind of got me attracted to sort of see that as a challenge, and I'm fortunate and lucky that I was able to do so in 1992. That's some time ago, but I'm glad I did. That got me into electrical engineering, which was the stream was, of course, my choice. I wanted to do electrical engineering. I liked that. And I mean, I think one of the great institutions that I've been part of my entire career, and I today these days I tell my son and whosoever I've met that, apart from the education, the kind of people that you come across in there, you do feel humbled that there are such good, great minds that are there across the country, such great
Mhm.
talent that you can kind of be along with, study along with, and watch them grow. So over the last 25 years, as I've seen people grow from IIT, some of them are CEOs, some of them are run NGOs. So the career span is across the spectrum. So it's been a
Mhm.
fascinating experience. I think going to IIT Kharagpur, studying there for 4 years, just for the breadth of people I met, just for the kind of studies I did. And I'm glad to report that sometime in December, they have invited me back to speak to the college, to the young grads, to see if I can inspire them. So we'll see how that goes. But a long-winded answer to your question, but hopefully I felt passionate about it, which is why I wanted to talk about it.
No, I hear you completely. I think it's quite a thing when you have to go back to school and talk to students, and especially if it's your alma mater again. Only imagine and relate to what it might be. But tell me something, when you say you talk to your son, do you push him to do engineering, or do you tell him to pursue a career in finance, or is he too young to take that decision right now, given that you straddle in both the boats?
Um, I would probably say, what I say to him is, it doesn't matter whether you engineering or you become a chef, but whatever you do, do the best that you can. And as long as you are doing that, there is a price that the world is willing to pay for that. So I'm not fussed about whether he joins engineering or medical or commerce or whatever it is. But as long as he's able to sort of, whatever he does it with full passion and do it his best, I'll be happy for it.
The root of my question lay in the movie Three Idiots, which was related to engineering and Baman speaking to his grandson at the end of the movie. But
True, absolutely.
Tell me, how did the switch from Tata Motors to Kotak happen? Was it just by default, or were you working towards a career in finance and you had applied, or did it just happen by accident?
No, actually, I think I must admit, this is an honest admission, that one of the things that we are taught at IITs, and I'm sure at most of the engineering colleges, is how to change a few things. How can you make the process more efficient? Whatever you're working on, you may be electrical engineer, you may be mechanical engineer, to change a few things for the better. But when I joined Tata Motors in Jamshedpur, I realized that my prime job was to maintain things. That sort of was not particularly intellectually challenging in my view, which is what made me think that, well, I might get frustrated too soon. And that prompted me to look out as to what options there are. And one of the options that was there was actually MBA. And actually, quite frankly, till that time, MBA was not really one of the things I aspired for. It's not that I always wanted to be a finance professional or something of that sort. But that's when I realized that, maybe in India, an R&D type of engineering job is not really kind of, there to kind of go for. It's more maintenance oriented, more where the upper faculties are not fully utilized. And when I had a conversation, heart-to-heart conversation with someone I knew closely, they said that, engineers tend to kind of have a quantitative bent of mind. So finance might be an interesting field to get into. And that's how I got interested into finance. And then that whole concept, then the whole thinking evolved. And that's really led me towards MBA. And fortunately, in the first year, I got into SPJN, and that got cracking. So that got me into the MBA. And actually, once in my final year of MBA, I thought, of all the things that I've got to crack more deals. So I wanted to become an investment banker. And then Kotak, a few senior gentlemen from Kotak came about to interview us, and that was the first. Incidentally, I got into Tata Motors, which was the first company in campus. And Kotak Securities was one of the first initial, companies on the finance field that came around that time. Remember, this is basically 99, and 99, 2000 was not a great time from an economic standpoint, or we sort of just coming off the hill. So anyway, I speak to the gentleman who interviewed me. Shall remain a secret for now because he's there in the markets as well. But he said, "Why don't you join in equity research? And and later on, if you want to become investment banker, please by all means do that." So I said, "Okay, we'll see." So I joined Kotak in that under the garb of ultimately becoming an investment banker, wanting to become an investment banker, but into equity research. But since then, the whole sort of concept of research, financial research, which is what you all do, to find something using mosaic theory, which is not widely known, and not by insider information, by virtue of analysis, by virtue of putting all the things together, making an investment case out of it, and investing on the back of it. This is the essence of what all we do, depending on which part of the spectrum you come from. You can come from broking, you can come from investment management. I think this whole process has fascinated me. And over the last 25 years, I have never got a single day where I'm not fascinated. I'm not sort of passionate. I'm not sort of sort of felt bored that I have chosen this field versus that of other. So I think equity markets, equity research, getting to idea generation and stuff like that is one of the passions which I discovered by the way, even though my initial intention was something else. So for the listeners who are there on the call, one of the things I would say is that be always open-minded. What you know at the moment, what the knowledge that you have takes you to a certain point. But after that, if somebody is well, where you have new information comes in, soak that in, and then kind of, go on to assimilate that information rather than be very boxed into concrete views. So a long-winded answer to your question, but that's the story behind it.
So on a lighter note, when you look back on your career with your colleagues at IIT Kharagpur vis-a-vis your colleagues at SP Jain, who do you think turned out better financially?
So the answer is the classic English answer. It depends. One of my batchmates is Vipul Beneet Sinha. He's the CEO of a company called Rubrik, which is valued at north of $1 billion. And similarly, one of my colleagues at SP Jain is one of the founders of another business, which is an ed tech, as they call it.
Okay.
And has recently sold his company. So both of them are very successful. If I take extremes, those are the two extremes that have done well. But in general, I think it's, I would say that, the more varied nature of activities that are being done by the grads from IIT. Our people, my colleagues in, or my fellow mates in SP Jain, they are more sort of in the same sort of a normal distribution.
Interesting. Actually, I'll tell you a small anecdote about SP Jain and myself. When I moved back to India after brief stint with working with Citigroup in Chicago in 2002, I decided to take the CAT exams back then. And I had secured a 92 percentile. And I actually somewhere was delusioned in my mind to believe that I would even get a call from IIMs. I did not even get a call from SP Jain. So I actually took a train from here and went down, and I won't name the professor. He actually took me to the dean and I met them. And that's probably the first time I realized that India had a population problem, that with 92 percentile, if I could not call, I was like, there's something wrong here. And then, that was my little encounter, brief encounter with SP Jain, so to speak. So what prompted you to do a CFA down the line then, after doing an IIT and MBA? Is it just the thirst for knowledge to reinvent yourself, or did you just probably do it more from a networking perspective to get some more global perspective? What prompted that decision?
So you see, basically, I took my MBA in 1999, and after that, I developed a strong passion for equities in various forms, as I talked about idea development and stuff like that. By the time I came to 2006, 2007, I realized that I had become too focused or too narrow in one area, and I needed to call it rediscover myself, call it broaden my horizons and stuff like that. And CFA was a reputed institution which allowed you to do so. The degree is well recognized, and at the same time, I realized that it's not an easy thing to do. So I took that up as a challenge, and in 3 years straight, we sort of I finished that. But that kind of opened myself up, opened my horizons from doing equity research to more on the investment management, which is when I relocated abroad as well. After I finished my CFA. So it kind of, part of rediscovery, part of learning new things or relearning new things. Theory generally evolves over a period of time. A mix of all of these actually prompted me to do CFA, not networking, not any other things, but mostly to sort of, really unlearn and relearn in a more broader basket.
Hmm. Talk a little bit about your stint at UBS. What was that like? It was a very long stint. What were your learnings over there, and at what point did you decide that you wanted to take the move to State Street?
So actually, UBS stint was not a uniform stint. It's divided into two parts. I started off in about in the year 2000 as a budding tech analyst, the hope hopefully to grow into an MNC and establish a name for myself in Indian markets. Over the subsequent 3 or 4 years, I went from no one to the probably the youngest at that time, or maybe not. The I rated #1 tech analyst around that time period of time, and I went on to head the tech research within Asia for UBS from a tech perspective. And so that went well from that standpoint. But then by the time we got to 2006, 2007, I had achieved whatever, in my opinion, I had to achieve in that particular line of field. And I thought, it's time to rediscover, relearn myself. And that's when I took the CFA and I kind of, spoke to my boss and stuff like that. And I think I have to say, UBS is a great institution in that context. They gave me an opportunity to interview with UBS Global Asset Management, which is in London. They said that, well, there is a role on the buy side, which is on the asset management side, to sort of, explore something different, where you can manage money on a thematic basis, also kind of, look at developed markets and emerging markets. It completely opened up the spectrum for me. It involved huge amount of risk. It's easy to say on camera here, but trust me, when I had to make that decision, there were very few data points and very few people who would suggest this. And here I had a career where, I was ranked #1. If I were to be in that same position for the next 5 years, I would have sort of made my own money and said thereabout. But I chose to kind of, change direction, which is when I relocated from Mumbai to London to be part of UBS Global Asset Management in search of new challenges. And mind the date was 1st January 2008. Little did I know as 2008 progressed, how challenging it might turn out to be. But what I found out in my days at UBS Global Asset Management, fortunately, even though it was a new market, new areas to look onto, but I had tremendous performance. I outperformed the broader market by close to 23% in 2008 and a couple of in subsequent years as well. But not by that amount, but by a good bit. So they realized, hey, this guy can make money. So that's why I started managing thematic strategies, and things started clicking on. This is in London. So I moved from UBS Securities in India to UBS Global Asset Management, and I was one of the top performers there as well as I was in UBS India. So UBS turned out to be quite well for me overall, divided into two stints, one in India, one in London. And then came the opposite. I did that for about 3-4 years and kind of, was one of the top performers over there. But then an opportunity came about to broaden the role again to become an Asia Pacific portfolio manager. This was with State Street Global Advisors, and they had a boutique team in Dublin, and I had to relocate there. And I said that, okay, sounds challenging, sounds interesting, I have not done something before, so I took that up again. So I took that up. I did that. I raised from practically kind of nowhere to close to about $800 million in SSGA. It was fairly successful, and it continues to be after I left. But it's basically another fresh challenge to rediscover myself, not just in India, not just in emerging markets, but Asia Pacific. So I have run money for Australia, or in Australia, in Japan as well. So broaden the experience and whatnot. And after that, subsequently, I returned back to India.
So when you were at UBS in India, I'm guessing you probably worked with Ashwini and Sandeep and
yes,
perhaps maybe even Bhanu Baveja at some point.
No, Bhanu Baveja was not in India, but Ashwini Agarwal and Sandeep Bhatia. Sandeep Bhatia was my boss. So I worked with them. Yeah, Ashwini was the head of sales, both of them are some of the great guys to work with. But I worked with them. Yes.
So incidentally, I think I was also in UBS around the time that you were. I had a brief stint in investment banking, 2004-5, with Manisha Girotra.
Oh, I see. I know Manisha quite well. Okay, okay. We were,
Yes. So the Hecht House office at Nariman Point,
yes, yes, of
which
course,
is right
absolutely.
down the road from where I am right now. So yeah, I guess you and I have been colleagues separated by Chinese walls at one point. In the world,
True,
as they say.
true, true.
So,
It is.
tell, so tell me now. You said you were tracking technology. It's a sector we track very closely here. Our own head of research has over 2 decades of experience tracking it. Uh, how have you seen that sector evolve? Over the last 15, 20 years from sort of being a number one rated sell side analyst back then to where you are today, and the way companies have evolved, or how structures are changing. And we've been hearing so much about it of late. Even in the week gone by, what we've heard from companies like PCS, Wipro, etc. uh, has the world changed very dramatically, and is it going to continue to change very dramatically from someone who's looked at the sector as closely as you have?
Yeah, the world certainly. I would say the the way of dealing or the way of doing things have certainly changed. Right from my early days when Y2K offered Indian companies an easy pass onto the Western world to kind of get exposed to projects, to moving on to package implementation, which is more like industry-wide packages, which was sort of like SAP, Oracle, etc., to being implemented within the organization, to things moving on to cloud, which is outside the organization but centrally handled, and more software as a service kind of an opportunity, and to now where things are moving completely digital. I think during my time, and even now, IT has seen 3 or 4 waves overall in the way the demand pattern has changed. And actually, if you look at IT, one of the great things that it teaches you is how to sort of stay humble and hungry and foolish, as Steve Jobs used to call it, because things change quite fast. And if the company is not able to be in sync with the change, they can get completely whipsawed in the next cycle. And I noticed that during night times and even now, Accenture as one of the companies which has kind of migrated through all the waves quite well. And while Indian companies actually did quite well in Y2K package implementation and stuff like that, once we came to cloud and infrastructure services, etc., the initial leg Indian companies actually missed the bus because they needed to make some investments which actually didn't happen in time, and things became expensive later on for them to sort of get onto the bandwagon. But I now notice that with the digital coming around, the offshoring, which is kind of which was there or thereabout, could get a new meaning because work from anywhere, work from anywhere, and stuff like that can actually increase the offshoring over a period of time. This is, of course, I'm talking about over the next 3 to 4 years, rather than kind of in the near term US election, this, that, the other. And as
Mhm.
that happens, that will be a new wave how to sort of think about IT. So over the last 20, 25 years, IT companies and observers like me of technology have observed significant amount of changes that come through. And it's been fascinating to see how some companies have looked to ride the wave. Somebody have been able to do, some people have not been able to do so. So in a nutshell, a lot of changes. Some I mentioned, some winners, some losers, as always. But overall, it's been a fascinating part of the journey to kind of be an observer and be part of it.
Interesting. So now, when you were working with State Street, you were on the outside looking into India, comparing it to, I'm sure, a lot of emerging markets as well as global markets. And now you're on the inside looking even further inside. How different has the experience been with managing money from the outside? I'm assuming with a little bit less noise than it is when you're in India and you have people like me and my team hounding you down every day. So is it easier from the outside in, so to
I
speak?
think, I think first of all, it's a great question. I would say that to answer this question in a holistic way, uh, overall, having run money in developed markets, having run money in emerging markets, and having run money in India. Having seen companies which are in their old age, companies which are young, and companies which are growing, it makes one, from an investing standpoint, very objective. And when you look at a company, you can sort of see, you can see through how this company will look like in 15, 20 years time, no matter what the stories which are get thrown at you, which you call as noise. So I think having done different things in life, having looked at markets, various different markets, it certainly gives me that perspective that when I look at a small company, whether it's kind of a beverages company, or whether it's a, it's a small brand or whatever it is, it makes me a lot more objective that these heady growth days might not be there, and how things change with regards to competition and whatnot, particularly having seen great companies like LVMH and having invested in them over a period of time. Coming specifically to your question, outside in, yes, when you are inside the country, obviously you start to feel a little more emotional about the local issues, whereas when you are based abroad, some of these things you can look at it from distance and a little more objective, and you hear the criticism of India in terms of sluggish decision making, this, that, the other, in a little more objective fashion, objective way, as opposed to when you are inside out. When you are sitting in India and you watch the local channels, people talking passionately, you can't help but be a little more emotional about it. So certainly, sitting outside in, that makes you more a little more, I would say, less emotional, more subjective. But having done, different markets at different points in time, it does give you, it does make you, in general, company-specific analysis a lot more objective than it was earlier. And hence evaluate ideas in its true essence, rather than getting carried away by the near-term news flow of growth rates or margins or whatever it might be. I think apart from that, I would say that having managed money in developed markets and emerging markets, particularly in India, I would say the relative mispricing that you have of assets, particularly in equities, is quite high still in emerging markets in India in general, as opposed to what you see in developed markets. And hence, to that extent, making money as in generating alpha in developed markets is even more tougher, because it carries closer to more perfect markets than where we are, as opposed to in emerging markets like that in India. Also, liquidity, while there is sufficient amount of liquidity to buy plethora of stocks overseas, in India, the liquidity goes down significantly once you go down the market cap chain. That's the other constraint that we have. But to answer your question in a holistic way, those are the kind of changes that I observe, having managed the money from based abroad, having done different markets, and based in India, managing Indian money.
You are one of the more kind people, Trideep, who said that you actually hear people talk on news channels in India. I thought that concept stopped years back. Nobody speaks on Indian media anymore. I think it's more shouting that happens. But that's a kind observation from your side. How did Axis happen?
So when I came back to India, and I was thinking of should I start something on my own or join another platform and stuff like that, I met Chandresh. Chandresh has been an old acquaintance and a very good investor, seasoned investor, whom I had known for about 10, 15 years in my first innings in India. And I was actually looking to set up something on my own when he suggested that, we would like to start the PMS. We don't have a PMS. We don't have an alternative platform as yet. We would like to kind of, do that. Would you be interested in kind of doing that? But bear in mind, we are big in our MF business. We have nothing in PMS. I said, that sounded like a good challenge to start, because I've had experience working in, global organizations, in systems and processes which are well established, and then taking it to a next level. To start from scratch, to kind of not have anything given to you and kind of establish the presence was something which is new and challenging for me, which is why I took that up as a challenge. And I think last 4 years, fortunately, God has been kind and our performance has kind of held up quite well. On the PMS side, we will be in the top 10, whichever way you cut it. That's kind of helped us in the relative rankings and scale up the business overall by a good bit. We still have a significant room to go. But that kind of, so overall, the challenge of setting something new on a platform which is there, known for related stuff, but not exactly what I was planning to do, is the thing that spurred me on to start the PMS or the alternative now the alternative business within Access from an investment standpoint. And it's been a fascinating journey so far. I haven't had any single day to repent.
Yeah, no, it's a good bunch of guys there. I remember we started interacting with Axis when the equity AUM was not even 5,000, and Jinesh and Sudhanshu and Pankaj, all of them. Jinesh was a lot thinner then. You can tell him I said that. And I think even your new bunch, that has come in over the last few years, Shreyas, Anupam, it's a good bunch of people. You have one of my very own people sitting over there as well, in Nitin, who's been with me over the years at various firms. But yeah, it's a good bunch of people. How do you approach investing? When you look at, especially say when you're looking to invest in markets that are, as you were discussing before the start of the show, at highs like these. I mean, do you keep a very concentrated portfolio? Should you be a little more diversified to hedge your risks? And there's always this talk about value versus growth, active versus passive. If you were to sort of go through all of these, what is your own thought process on the same?
So I think these are some of the jargons where investment world makes it tough for other people from the outside. So the way I think about value versus growth, since you bring that up, is ultimately value investing has to work. How you define value is the question. Do you find, and as Warren Buffett said, value and growth are joined at the hip. Essentially, a stock which is trading at meaningful discount to its intrinsic value is where there is value. And as long as you invest in a bunch of such companies which are currently trading at below the intrinsic value and has potential to kind of go up to the intrinsic value, you will make money. Now, in my opinion, that's what you call as value investing. What in the traditional bucket, what people call value is basically companies which are, low in multiple. And that is a rudimentary definition of value, which kind of used to be defined during Pengram's days, a long time ago. Those mispricings have got sort of, corrected as markets have become more efficient. And now we have to sort of, look at the nature of the business to define whether there is value or not. I had actually written a short book on that, or a big article on that, whichever way you call it, where I've defined this as what I call a static value and what I call as dynamic value. What I call a static value is a company which is kind of optically cheap, and there is a bounce which can happen. So it may be an SBI trading at a price to book of 0.7, 0.8, which bounces to about 1.2, 1.3 times price to book. You can play the bounce, but once you play the bounce, you've got to sort of get out of it. That's what I call a static value. Statically, there is a value which is created because there is a valuation gap in it, and a lot of traditional value investing guys or value investing gets confused with that. That's one way to make money. It's relatively tougher because you've got to know when to get in and when exactly to get out. If you get that wrong, you'll be left holding the baby and stuff like that. The other part of the value which I'm more fascinated about is what I call as dynamic value. This is obviously you want to kind of make your starting point as low as possible to where the intrinsic value is. So you hopefully have a static value component to it, but the value gets generated by the growth that it creates over a period of time. And I think this sort of mispricing kind of happens over a longer period of time. There's a time arbitrage which kind of which gets in once you invest in such companies. And usually, holding on to such companies creates long-lasting values for investing. So I think over a period spanning about 20, 25 years, what I learned during MPA was more of what I would call a static value, stocks that are cheap and optically good to buy. But as I've sort of practiced investing and over a period of time, I've become a follower of what I call as dynamic value, where value there is with regards to the starting point of investing. If you start at a more expensive point, you may not make money. So the starting point is important. But what is important even more is how the nature of the business kind of evolves itself over a period of time. Understanding in advance and putting a value to it and hopefully buying at a discount to it, in my opinion, is the way to go about investing. That's my style of investing. In the short term, you could call it a quality at a reasonable price. When I say reasonable price, I mean I'm looking at the valuation component, not completely oblivious to it, but I'm mindful of the nature of the business, which is quality as well. And that's why I define the static value and dynamic value. So I hope that answers your question.
It does, but I was just thinking that really, for someone who's say in their mid 20s, who's just entered the market, or say even a 30-year-old, and he's been in the market for the last 5 years, hasn't seen this value trade play out. I mean, whether you alluded to public sector banks, you could look at maybe an ITC, you could look at oil marketing companies, power utilities, companies like PFC, REC. I mean, these are virtually no-brainers, but the Hindustan Levers of the world and the Nestle's of the world just keep getting more and more expensive. And MRF just keeps hitting new highs. So somewhere, people is it not? I mean, it's all good to say that invest money in the long term, but in the formative years of your investing, especially let's say for a person who's 30, 31 years old and he or she has been putting their money for 5, 6 years, this trade really hasn't played out. So they, probably be happier buying a lever or an Nestle or an MRF and saying, you know, it's probably a safer bet than putting in an FD. But I'd rather put my money in an FD than put it into any of the public sector banks and play it through there. So what do you tell someone who has that bend of mind?
I would say to pay more attention to the definition which I talked about, static value and dynamic value. SBI has clearly got a static value, but if you look at from an overall period of time from the market share that they have, given that it comes with a welfare motive in mind, it might turn out to be a market share donor to the private sector banks, which might sort of play out over a period of time. So from a dynamic value standpoint, which is value the business creates over a period of time, I think the market share dynamics may not lend itself to sort of over a period of time generating value over time. Similarly, ITC has a ton of, it's cheap, valuation wise it is cheap, but the dynamic value component, which is overall growth rates, and whether they are able to kind of grow at a significantly higher rate than GDP growth, overall has been under question. So I would say that not get boxed in the static value type of stocks where they appear cheap. The cheap stocks can remain cheap forever. The expensive stocks, depending on the quality of business or the type of the business that they are in, could make you good returns. So not just get put off by the initial starting multiple, but try and understand. This is particularly true for investors who are in that age group that you mentioned, to try and understand the nuances of the business rather than getting stuck into the valuation multiple. And of course, valuation multiple is important. And if you buy a stock which is at an all-time high, at a peak, making money from that becomes difficult. But time generally is a friend of good business. So, understanding the business fundamentals, understanding the business drivers, understanding Nestle over a period of, last 3-4 years has grown earnings meaningfully. Hindustan Unilever has seen meaningful margin expansion. Earnings growth has come through. Whereas some of the other names which you mentioned, SBI for sure, has not seen growth coming through at all. So just because it is cheap, it's a necessary but not sufficient condition for making money for investors. So for making money through investors, it's not that easy. Otherwise, everybody could look at a Bloomberg or a valuation table and off you go put money to work and make money. Understanding the business fundamentals, how that will evolve over the next few years and over the long term is what I think is important. So I would say that understanding the business fundamentals, understanding the business drivers, 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 understanding the business drivers,
You can look at a Page Industries or any of the other names that I spoke about. Even, you could throw in a Bajaj Finance over there at its peak, obviously. So at what point do you cross that line where you say, everything is right, but no, not anymore?
Correct.
It's probably a very hard call to take, I assume, especially if
Yeah.
the stocks done well for you.
In investing, in my view, and this is an honest opinion, in investment, in my opinion, selling is a far difficult proposition than buying. You see, our human brain is naturally it comes easy. You may get it wrong, you may get a few things wrong, but broadly, you know the ingredient. When to sell it takes a lot of gray hairs, and that's where years and years of experience, multiple failures, multiple times when things haven't worked out, and multiple times when you get carried away by the near-term emotion or the news flow, makes you much more grounded, much more balanced, and it comes over a period of time. But if I were to sort of look at a certain parameters, which kind of should uh, get a few flashbulbs kind of ringing. One is that if the company all of a sudden everything is going fine, but incrementally growth gradually tapers down. Um, if there are some management departures which happen, particularly kind of at critical positions, if they start losing market share, and if they are trading significantly ahead of valuations that they have been in the past. Now, that does not necessarily mean that it will fall, but generally that should make one careful that we are now trading into uncharted territory. And maybe there is a change in the business model which is happening, which is why it is sort of going into that direction. But it's better to understand that, internalize that, be comfortable with that, rather than just staying put that things are going fine. Why should I bother? So those would be three or four parameters which would actually kind of make me uncomfortable with regards to when things are going too well. Also too well too soon. I mean, in Page Industries, I recall buying it at 13,000, 14,000 odd levels, and within 2 or 3 quarters, because they delivered so well, it went to 32 grand. You know, and that's when I realized that it is too much too soon, and I sold a good bit of my holding. Unfortunately, and then it panned out. It kind of went down all the way to I sold majority at about north of 30,000. They went down almost over 18, 19,000. So, but just as take an example overall, just to illustrate rather than anything else, that sometimes some of these soft parameters, when there is no panic and you're calm to sort of respond to that, makes a good selling case. But to make that decision is one of the tougher things to do in investment rather than buying, is also something which I would admit.
Let me try and ask you another quasi-tough question. Sometimes when people are conversing about stocks, they generally tend to ask people which was your best stock idea and what made a lot of money for you, or which was your worst idea that you bought and you were so convinced. Can you remember the idea that you didn't buy and did really well? You may or may not have been entirely convinced, or you may have been convinced about it, but you still didn't go ahead and buy it and it did really well. Do you remember any such that could have made a material difference to your portfolio?
It's not a question of any such. There are many such. So, I mean, overall, I would classify what you say that as mistakes of commission and mistakes of omission. So mistakes of commission are kind of hardwired in your head because you see it day in day out. Mistakes of omission kind of gets blurred over a period of time, and that really kind of goes on to sort of goes on to hurt over a period of time. I would say I was late on to the Bajaj Finance bandwagon when I sort of in my portfolios, particularly when I used to run overseas portfolios. I never thought, because this NBFC business model, the way it happens in India is relatively unique. In overseas, it forms part of other bigger organizations, and it took me a bit of time to really understand what Bajaj Finance was looking to do. This is, of course, my pre-India days. So when I was with the managing money, in India, but based abroad. But Bajaj Finance started to show its kind of it hoodwinks or things going well, particularly in the initial years. They were like crazy returns over a period of time. So that's something which I missed. This time around, of course, when I came back to India, it was late, but I still got onto it. But I would say that I was late and I missed a good bit of the initial maybe 3, 4, 5 bagger on the back of that. But the other lesson in this is that never say never. When you learn, when you learn your mistake, accept, and if there is still potential to go ahead or make money from it, take a subsequent bet. Don't just completely stay away from it. So that's one which I would say on in my earlier part of the career. And I would say off late I sold D-Mart a bit too early. That's another type of mistake, which is kind of you think that stock is expensive, and overall it has done quite well even subsequently when I have sold. So that's another. Those would be two examples which I would give on either side. Where one I was late, the other I was too quick. But I think broadly, discipline. I mean, just for the viewers' sake, while you do have mistakes on this side or on that side, but if you follow a disciplined approach, what it does is it keeps you in that track, in that zone. If you play tennis, it keeps you in the tram lines, and that's what keeps you keeps you going in majority of the times. And investing is a battle of averages, not a battle of how much sixes or fours you make. You can make 1 or 2 sixes, but then overall you lose a ton of money on one stock, then the whole thing gets balanced out. Ultimately, it's a battle of averages. It's about staying in that zone and kind of being in that averages or being in that range so that you can make long-term wealth for investors and for yourself. That holds the key.
I couldn't agree with you anymore. In fact, if there's one sports person I felt who could make a very good investor, it would have been Rahul Dravid. I think he just, if you just took the basics of what he did and applied to investing, I think he would have probably been a fantastic fund manager if he ever chose to do.
True.
What keeps you busy beyond work, Trideep? I believe you have a boy and a girl. Do you spend a lot of time with them? Are you much into exercising, reading, traveling? What keeps you busy beyond work?
A mix of these things, but I do outside of work. I have a passion which is tennis. So I play competitively as well. Of course, limited by my ability, but I do try and play once every day or quite as frequently as I can. And that's what keeps me busy. It keeps me objective. It keeps me kind of it keeps me alive to the sense of challenge that it is still there. That every day, no matter what you do, every day is a fresh game. And actually, there are quite a few parallels between tennis and investing. And I love that game. So overall, beyond all the things that you mentioned, which is family, reading and whatnot, I play tennis. That's what keeps me busy outside.
I hope to catch up with you someday on the sport. I'm an avid player and watcher of it myself. Are you more a fan or Federer fan or a Djokovic?
I am a Federer fan, beyond a doubt. I mean, there is no question. There is no question. No one comes close. I mean, Federer has actually converted tennis from a mechanical game to an art. And I think having seen him play while I was in London in ATP Tour finals in one of the matches live, I couldn't agree with you more. I mean, since then, no one even comes close. When you look at the rest of the games, it looks more like drudgery. When you look at Federer, it's more like a piece of art which is flowing. And obviously, I don't want to offend any other fans of Djokovic and Nadal who are listening. And I certainly don't want any hate mail so that if they're great players by their own merit. It's just my personal belief that overall, having seen him play in live, and I would stand with Federer any day.
I would have expected no other answer. Actually, I was anticipating that answer from someone who manages money and who needs to keep a calm head. You, of course, have the aggressive investing in the form of Novak Djokovic, who is someone that I've admired greatly over the years as well. But it's been fascinating chatting, Pradeep. I think your journey, your approach to investing, your thought process, the changes that you've made, why so, and how you approach stock picking. I think it's been wonderful listening in. From my perspective as well, I've learned a few things from you, and I'm sure the people who've logged into this broadcast and who'll probably listen to it on YouTube and social media going forward as well will probably walk away with a few things. I hope you enjoyed being on. It's a slightly different format that I keep here, but I hope you had fun being on.
Absolutely. I think the questions are very different from what I'm normally used to. So it was fun answering those questions. It's great format. I think you should keep it going. I think over a period of time, happy investing. And to the listeners, stay healthy and stay safe. Thanks for having me on your show.
Pleasure. Thank you so much, Sudeep, once again for your time, and to everyone who's joined into this broadcast as well. Thank you so much. Stay safe, and once again, a very happy Diwali to all. Thank you.
Happy New Year. Cheers. Bye-bye.